Alrighty, everybody, I hope you are pumped up for our next lesson, which is all about the market and the different relationships in the market. And so today I'm just going to put it out there and say the main reason why we're doing this lesson. The market is the driving force behind every trade. You cannot look at each trade in isolation. In other words, you can't just look at the trade setup, at the pattern, or anything that helps you enter the trade just by looking at that particular equity. No, you have to look at the whole entire market and what the market is doing. So remember this, the market is the driving force behind every trade. So when you're trading, a successful trader always knows what the market is doing at any given time. And so I'm using this picture of somebody riding a bicycle to just kind of have you understand this a little bit better, to give you this really hopefully helpful analogy. And so imagine your trade setup, and this is your isolated trade setup, just looking at the chart. Imagine this being your biking setup. Let's say you want to go out there and you want to ride a bicycle and you want to be a high performance, you know, person here. You want to just become almost an athlete at this, and you want to become really fast and efficient, and just overall have a really good performance riding a bicycle. So you want to be like this guy right here. So what does somebody who is successful do here? How do you put the odds in your favor to become a really good athlete, to build up speed and endurance and all of that? Well, number one, you need the right tools. And so you're going to go out there and buy the bicycle. So of course the bicycle that costs thousands of dollars, has a bunch of different speeds, is suitable for your style. That's the best bicycle out there. And then you might even work on yourself. You might go out there and buy a helmet. You might buy gloves, so that you get a better grip on the handles. You might buy athletic clothing, to help you out with the aerodynamics, to help you, to help cool you down as you sweat and things like that. You might get, sunscreen and all these different things, the right shoes, that also give you a nice grip. Um, and so you're going to go out of your way, and all of these things, once you add them up, they are going to help you. They're going to put you out there, they're going to put you up on the next level. They're going to raise you so that you have a greater chance of becoming this high performance athlete. Well, okay, this is great. So let's compare this analogy to the stock market. So how would we apply something like this to the stock market? So let's say you want to go out there and buy Apple, and everybody loves Apple, so let's use Apple as an example. So you look at the chart on Apple and you see this really nice pattern. Maybe you see a bullish consolidation pattern if you're familiar with charting patterns. And it might be approaching some sort of moving average. Maybe it's oversold. So technically, just looking at the chart, just visually looking at the chart, you might see a lot of different factors that tell you that Apple should be popping really soon. So you want to buy this stock. So this is your trade setup. So you see a lot of different factors that are telling you, yes, go ahead, buy the stock. And so yes, you have increased your odds. So just like the guy that, went out there and bought the best bike, clothing, helmet, and all of that. Yes, you have increased your odds. That's true. But one thing, this biker, this, person on the bicycle, not a biker, but this person here, one thing he's not looking at is the terrain, is the environment. Okay? So it's great that you have the best bicycle gear and all of those things. But what if it starts raining? Does it matter? What if, you're in this really rugged terrain, and what if you have to push uphill? Okay? So of course this is going to require a lot of effort. And let's say somebody else comes along and who just doesn't care about this at all. Okay? He buys the cheapest bicycle, probably an old bicycle somewhere in a thrift shop or who knows where, just puts on his casual t-shirt, shorts, whatever, doesn't even bother with the helmet or any of that. And he just gets lucky. So he goes out there in good weather. He notices that most of this terrain is downhill, so he doesn't even have to pedal. He just lets the bicycle roll down the hill. And so this guy who tried really hard to equip himself, to buy the bicycle, this poor guy is pushing uphill. He tried his best, and now this other guy is basically looking at him and saying, "Oh, I'm just gonna laugh at you because I'm just, pedaling downhill. I don't have to do anything." He basically is in the right environment, in the right terrain, in the right temperature, so his surroundings are conducive to his, whatever he's doing, his effort. Same thing with the market. So even though your trade setup might be perfect, even though your Apple long is just screaming, buy me, right? Well, what's the market doing? Okay? You want to make sure that the market is going to be in the same direction where you want to enter your trade. So in other words, if you want to go long or buy a stock such as Apple, you want the market to give you signals that it's going to go up. And if you want to sell Apple or go short, you want the market to tell you that everything is going to go down, right? So the best setup here is, when we kind of go back to the bicycle analogy, you want to be this guy who buys the best gear, the best bicycle, the best clothes, and all of that. But at the same time, you want to choose your terrain so you are the one that's pedaling downhill. So you have two factors that are basically multiplying, amplifying your performance. You have the gear and you have the terrain. So imagine the speed you're going to pick up. Imagine, your performance. You've basically squared everything. You've amplified everything. And same thing with trading. You cannot look at each trading setup in isolation. Number one, you have to look at the trade setup itself. Obviously, you want to see that chart. You can't just blindly go into Apple and just, randomly choose, am I going to buy or sell? You have to know those things. You have to be able to read the chart. But at the same time, you want to know what is the market doing. Okay? And the market here, by reading the market can help you immensely. A lot of people don't realize that. I personally have 4 screens, and I am mostly a day trader. I do have a little bit of, swing stocks every once in a while, but for the most part, I am a day trader. And so when you're a day trader, you have to know, what's going on at any given time, because every second counts. And so you always have to know what the market is doing. But I have 4 screens, and 3 of my screens, they kind of, span horizontally. So I have this very kind of I have this spanned view of my charting software. But 3 of them are going to be my charting software. But out of the 3 screens that I have, 3 monitors that I have, one of them at all times is telling me what the market is doing. Okay? One of my screens tells me what the market is doing, what the dollar is doing, what copper is doing. Maybe if I'm, trading something like Apple, I want to know what the NASDAQ is doing. If I'm trading something like JPM or Goldman Sachs, I want to know what the financials are doing. And so you have to kind of be able to set up certain factors in the market that are going to help determine, if you should take this trade or not. And that's the beauty of this. The market can justify your entries. So, if you see that, okay, I should go long Apple, well, look at the market. What is the market doing? If the market looks pretty healthy, if the market looks like it's going to go up, guess what? You will have just found another reason that supports what you were going to do initially. But at the same time, looking at the market can also stop you. It can stop you from taking a bad trade. So great, you found, a long setup on Apple, but guess what? The market is selling. You see a red candle after a red candle after a red candle. No way I'm buying Apple. Okay, I might even wait for, some sort of short setup later on. Okay, and also once you're in the trade, the market, just by looking at the market, it can help you anticipate what's next. Okay, because nobody really knows what's going to happen. And so, a lot of people are rigid about their risk to reward ratios. And it's great to kind of have a general idea of where, your entry and exit should be. And I do commend people who actually stick to their rules, and that's great. But the problem is that they may not get the most out of their trades. So think about it. Let's say you go long Apple and you figure, well, you know what? There's this next resistance level, and this is where I'm going to sell my stock, and I'm going to make a little bit of a profit. Well, that's great. That's a really, really good strategy. You need to be disciplined like that. But what if in the middle of your trade, all of a sudden, the market just starts flashing green and it breaks, out into the positive, and this is unexpected? Well, guess what? Maybe Apple now is going to break through its resistance as well, and maybe you're going to get more out of your trade than you initially calculated, right? Now, of course, you don't want to get greedy. You don't want to be that pig that got slaughtered, like they say. But, maybe you want to wait a couple of minutes depending on, how you're trading. Maybe you're a scalper or a day trader or a swing trader, But maybe you want to give it a little bit of time to kind of see what Apple is going to do. Is Apple going to react just like the market? In that case, you're going to ensure that you get a greater return on your trade investment. Or is Apple just going to go to its resistance level at, and then if you notice that it doesn't really break out of it, well, you gave it a try, but you took your trade, you took your exit and your profit, within a reasonable time frame, and so you didn't really lose that much. But, at the same time, what can happen, the reverse can happen. So, you're anticipating that Apple's going to go up and something really bad happens in the markets and the market starts selling off. Well, guess what? Maybe now it's time to get out of Apple. Maybe this is a red flag, and maybe this can protect you from losing a lot of money really quickly. Maybe Apple's going to react the same way. So this is what I mean when I say that the market can help you anticipate what's next, because it's this additional chart that you can look at, and this can help you determine, whether you should stay in the trade or get out of the trade. Whether you're going to make a higher profit than anticipated, whether your trade is going as you expected it to go, or maybe something happens and you need to get out of that trade as quickly as possible so that you can cut that loser. Okay, now I have written down here also that the more established the stock is, the more it trades with the market, because it is the market. Now, when I say established stock, I mean large cap stocks. These stocks that for the most part I trade, and maybe if you follow my trade, maybe you started trading them too, but these are large cap stocks, like I said, Apple, ExxonMobil, you name it, GE and Microsoft, and maybe not even the blue chip stocks because they don't have enough volatility. But basically, I'm talking about stocks that trade about maybe at least 1 or 2 million shares on a daily basis. So these are the higher cap stocks. So the more established the stock is, the more it trades with the market, because it is the market. So the larger the market cap of the stock, okay, the more in line it's going to trade with the market, because again, it is the market. Think about it. What is really the NASDAQ? The NASDAQ really is Apple. Okay, and so if you're looking at the NASDAQ chart, more than likely it's going to be very similar to Apple, very similar to, I don't know, Google, or very similar to Cisco, Intel, and these larger companies, okay? And so the more established the stock, the more it trades with the market, because it is the market, okay? And so now you have two charts that you can look at, okay? More factors that are going to give you more confidence in your trade, okay? Now there are exceptions. Number one, small caps, okay, and mid caps too, because they're not really part of the market. They tend to trade in a detached manner. So, sometimes, for the most part, if the market is going up, these stocks are also going to go up. But as you know, there is more volatility because less is known about them, okay? And it takes fewer buyers or sellers to move the stock, okay? So there's going to be a little bit more manipulation, news, and things like that, and earnings, and a lot of those things, with news and earnings, we kind of see these gaps and things like that. And so those are the exceptions here, okay? So those things are not necessarily going to trade with the market, okay? So these things are a little bit more unpredictable, okay? But what I'm trying to say here, again, to summarize, is that if you pick these stocks, okay, these large cap stocks that trade with the market, they're going to give you an extra layer of safety in your trade. Because think about it, the more reasons or confirmations you have when you're trading, the better it is. Now, obviously, you don't want to have analysis paralysis and just see, all these different indicators and all these things on your trading software, because you want to keep it simple. Like they say, keep it simple, stupid, right? But you want to kind of, within a reasonable means, you want to have an additional factor that's going to take your trading to the next level, an additional factor that's going to confirm the trade, and more importantly, you want something that's going to argue against your taking that trade. So think about it. Most people want to be in a trade. They're just very itchy with their keyboard, and they just want to go out there and enter a trade. But the most valuable resource, okay, that your trading software can give you is this: it can keep you out of a bad trade. And I cannot emphasize this enough, okay? It is more important, okay, for your analysis to tell you to stay out of a trade than for it to tell you to enter a trade, okay? Because the value of entering a bad trade, is it's just, you know, it's such a burden, okay, on your account, entering a bad trade. It's very difficult to explain that, believe it or not, because most people just look at it this way. Well, I have my risk to reward ratio, and as long as I stick to my rules, I shouldn't lose too much. Well, okay, that's great. You stuck to your rules, you lost a little bit of money, but you actually lose a lot more. Number one, you lost your time, okay, because you were sitting there and you couldn't walk away from your computer, so you had to monitor that trade. And number two, you lost your attention to anything else in the market because your focus was on that one particular Apple chart or whatever you were trading. And who knows how many other setups you missed that were maybe, so much better than this trade that you took. So lost opportunity, of course. And of course the monetary loss. So you lost, whatever you lost. Maybe your limit is, I don't know, $100 on each trade. Some people have larger accounts, so they say, well, okay, my limit is $1,000. So everybody has set rules. But when you take a bad trade, it doesn't matter if it's a small loser, okay? Any reason that would tell you to stay out of that trade before you even enter it, you have to admit that reason is powerful. And if just by looking at the market you can find that reason, okay? If just by looking at the market you can find that reason, to me there is a lot of value in that, okay? So understand that the market tells you, okay? The market can confirm when you should enter a trade, when you should exit a trade. It can help you anticipate what's next, but most importantly, by looking at the market, you can decide to not take a bad trade.